Hi there, welcome to a new episode of ET Now Insight. I am Snehi Shah, and today we decode the reality check facing India's new age tech giants. Once the darlings of the startup boom, these companies are now grappling with profit pressures, regulatory challenges, and investor impatience as investors now demand clear paths to profitability. On the show today, we'll throw the spotlight on Paytm, Eternal, Swiggy, and Ola. Each of these names disrupted the market with bold ambitions, but today it's no longer just about chasing growth. It's about staying afloat, growing wisely, and turning a real profit. From Paytm's fight back post the RBI clampdowns to Eternal's sharp pivot in quick commerce, Swiggy's profitability path amid Blinkit's aggressive play, and Ola's push in the EV ecosystem. We break down what's working, what's not, and what the road ahead looks like for each of these new age companies. So all eyes are on whether India's new age tech story can truly deliver. While we are talking about the new age tech companies, let's throw the spotlight on the first company that we're discussing on the show today, and that's Paytm. It was a stellar quarter for Paytm for the quarter gone by. The fintech major reported its first operationally driven profit since listing, aided by strong growth in lending and drop in its expenses. Paytm also announced changes in its board of directors, the group's CFO Madhur Deora to retire as executive director at the next AGM. My colleague Varun is joining us with the earnings fine print and how the quarter in general looked by for Paytm. Varun.
Well, so the quarter has been very good for Paytm because the company has delivered its first ever profit of around 123 crores, and also the EBITDA. I'm talking about the absolute EBITDA and not the EBITDA before ESOP, because before the company used to report the EBITDA before ESOP, and that was profitable. Now the EBITDA for the company has also turned profitable. Around 72 crores was the profit, the EBITDA that the company has reported, and the margins of the company came at around 4%. The company also said that going ahead, the company would report a profit, the EBITDA growth of around 15 to 20% going ahead for the next 2 to 3 years, and also till the end of this year, the overall margins of the company is also expected to improve going ahead from the 4% margin that the company delivered in this quarter. If you look at the valuation of the company, the stock currently trades at around 5.2 times FY27 sales and around 21 times FY27 EBITDA. Brokerage houses have been mixed on the overall results for this company. If you look at brokerage house like Jefferies, they have actually updated the stock from hold to buy and have raised the price target from 900 to 1250. Citi also has a buy call on the stock. They have also raised the target from 975 to 1215, and also BofA has raised the target on the stock. But if you look at Macquarie, they still have an underperform call on the stock with a price target of 760 rupees, and CLSA also downgraded the stock from hold to now reduce, although they have raised the price target from 870 to 920. So brokerage houses are basically saying that the overall results of the company are good. The company did what they have promised, that they have come in profit, but yes, majority of that is still in the price, and that's the reason they have actually raised the price target but actually reduced the overall rating on the stock. So it's a good story for Paytm. The company is in profit, but if you look at the performance of the stock price, it has been a roller coaster ride for Paytm. From the IPO price of 2150, the stock went down to 400 levels and it's back to 1000 levels. But yes, you still have a perfect bull versus bear case for Paytm, wherein someone says yes, it's time to buy, but some says that it's all in the price.
Okay, Varun, thanks for that. So, well, the street is out on what the next action regarding Paytm should be. And before we discuss that with our expert, let's listen into what the management had to say about the quarter gone by, especially the recovery that they've seen in personal loans.
It is not the agenda. It is rather investing in a few more line items that we believe are long-term growth. So we are not actively pursuing cost cuts, while I'm definitely pursuing whatever is not necessarily drop it out of the window. Where we are, obviously, if you read the earning release, we have pruned out every word which included EBITDA before ESOP, PAT before ESOP, or anything before ESOP. Next quarter onward, we will stop giving the ESOP line, and it will be only the employee cost, so that we are maturing towards absolute complete employee cost, including EBITDA or PAT, where the ESOP cost is the cost to the management. So there we go. No more adjusted anything.
Okay, that's a take coming in from the management at Paytm. But let's connect with Gurmeet Chadda, the managing partner and fund manager at Complete Circle Consultants, who's here to share his view on some of these new age companies. And Gurmeet, hi, welcome to ET Now Insight. First up, give us your sense on the numbers that we've seen for Paytm. Paytm is back to black this time around, but brokerages are still flagging off some concerns. What's your take?
Yeah, hi. With the disclaimer that we don't have Paytm in the portfolio, I think two, three things are encouraging. One, I think their payment devices continue to do well, whether it is sound boxes, different sound boxes or merchant machines. So if you see the quarter on quarter, there's a growth in sound boxes, there's growth in merchants they have acquired. Although the payment revenue is flat at roughly about 1,000 odd crores, I think the market would have been happier. And what it does is when you grow your payment business, you can leverage it to do loan. They have this daily EMI kind of a concept, right, which you can collect from the digital payments the vendor gets. So they're leveraging the payment business to increase the loan portfolio. I think where the profit also improved was that, so there are two types of loan you do. One you do with this without default loss guarantee. It is called DLG. And then one loan you do where you have to give some kind of a DLG to the lending partner. In last quarter, one of their largest lender actually allowed them to do non-DLG cases, which means they had to do lesser provisioning. Also tells you the asset quality is improving for the loans they disburse. So I think if they are able to leverage this part well, continue to grow the payment business and leverage this to get, better revenue on the financial services, because the market is still underpenetrated, there could be some runway. But we do not have currently, as I said, any exposure to Paytm. And I think market would want to see this kind of metric quarter on quarter before, actually developing a much stronger view on the franchise. Also, they lost a lot of people previously with host of issues they had with RBI. So they're also rebuilding the team. And in banking and financial services especially, the team and the culture is extremely important. So that will also depend in terms of their ability to build back the team because they had massive attrition in the payment bank and the financial services vertical.
Right, Gurmeet. So, well, yes, sustenance in the profit is what investors would like to see at present, and that's the take on Paytm. Let's move away from one new age company to the other, and let's talk about Eternal, because Eternal, remember, hit record high in their stock price as well as market cap post the Q1 earnings, despite shrinking profits, as the management remained optimistic on Blinkit's growth progress and narrowing losses. Brokerages across the board have raised targets as well, with Jefferies eyeing the close that 400 rupee mark per share. Sharad is joining us with more details on how Eternal's Q1 panned out and what were some highlights that the street was taking note of. Sharad.
Strong set of numbers coming in for Eternal, almost a 70% jump in the revenue. But the interesting portion is that both Blinkit and Hyperpure's losses were coming down as well. Overall, the guidance and the commentary cheered the markets also when it comes to the stock price for Eternal, and the brokerages have also given a thumbs up as well. Now, looking at the brokerages, Elara has given a maintained buy rating and they revised the target price from 300 to 340 rupees. And Nuvama also, they have increased it by 30 odd rupees, with the target price coming in at 320 rupees. The highest target price being set by Jefferies, upgrading it to hold to buy at the old target price of 250. Now that is a significant jump when it comes to the increase in the target price. Morgan Stanley has maintained overweight and a slight increase in the price. Goldman Sachs, it's maintained by. There is also a slight increase of almost 10 rupees in the target price. CLSA, it's a buy, a high conviction stock, and the target price jumping from 375 to 385. And lastly, JP Morgan, they have maintained overweight and there's a slight target price increase from 300 to 310 rupees. So largely the brokerages have given a thumbs up to Eternal.
Okay, brokerage is giving a thumbs up, and of course that stock was soaring more than 10% on the back of very good set of numbers, and a multi-day rally is what we saw on the stock. But let's also hear in from Eternal's management on what they had to say about the quarter gone by and the outlook going ahead.
Well, Sachin, I think quick commerce has definitely been a headwind to some extent for the food delivery business, because I think some of that consumption has also moved to quick commerce, right? But having said that, I think we still believe from a penetration standpoint and opportunity standpoint, we still do think that long term the business can grow at 20%, although that visibility is not there for the near term at this point. But I think there's enough going for us to be excited about the business. And I think if we do well and we are able to innovate and unlock more use cases for food delivery on the app, then I think we get back to those 20% growth levels again.
Okay, that's the word coming in from the management at Eternal. But it's very classic bull versus bear case, a very strong argument on either side for Eternal's quarter four numbers, because other than the segments that have done well in terms of the quick commerce growth and all we've seen, the most common headwind that we're seeing right now is, of course, the profit is down 90% on a year-on-year basis. For Blinkit, the EBITDA losses have reduced, no doubt, but it's still in a loss. And that visibility over there looks rather shaky. So if you take a look at the bear case also for Hyperpure, the management has said that they expect degrowth in the coming quarters as non-restaurant B2B business is expected to shrink. And well, lots of bull cases, bear cases, both of them coming in for Eternal. Food delivery also, you could make an equal argument, a 50-50 argument on both sides, because while their transacting users have gone up, GOV has sustained, you have NOV growth that is at a slight bit of a cut. Management has said that food delivery has been a headwind to the quick commerce growth, like we just heard them out. So lots of bull versus bear cases on Eternal. We also interacted with Karan Taurani as soon as the numbers came out to try and understand his first take on the stock and where he thinks the stock is headed going ahead. Let's revisit that conversation once again and listen into what he had to say.
So our price target has been revised upwards from 300 rupees to 340. Primarily, the reason for this is two. One is, of course, the better growth in the food delivery business, which will lead to better valuations for the food business on an overall basis. Second reason is a mild better growth in the QC business because of better store addition and because of the non-metro market picking up. Third is, of course, the profitability in the QC business. So we see profitability in the QC business coming back on track. And basis that, there's a re-rating in terms of valuation multiple of the QC business. So if you look at the QC business, until about 6 to 8 months back, when we saw this entire threat of new entrants, Amazon, Flipkart coming to the fore, JioMart getting aggressive, the quick commerce business actually went through a lot of de-rating in terms of valuation multiples. Zepto went into a price war. So I think all these things are now starting to cool off. The worst is behind us as far as competition is concerned. The worst is also behind us in terms of price war from Zepto. So basis that, I think QC business will see a re-rating in terms of valuation multiple, which will also drive share price performance. So basis all these parameters, we have graded our target price to 340 for Eternal.
Right, okay, so that's the word coming in from Karan Taurani of Elara to understand where Eternal could be headed, and of course the positive price revision that we've seen for the target price on Eternal by Elara. But Gurmeet, coming back to you and throw some light on the entire performance that we've seen across the quick food delivery, quick commerce space. This space is heating up, no doubt. But when you have a mixed set of numbers coming in from Zomato, at least operationally, internally, segment-wise, it all looks strong. Which side of the argument are you on right now? Are you with the bulls? Are you towards the bearish side when it comes to Eternal's quarters going ahead, let's say in the near to medium term?
Yeah, so you have to, dissect the numbers basis what you want to position yourself for. So if you look at food delivery business, I think now it's mostly two large players, right? And that market will not grow at 30% now. In fact, they are guiding for 15% this year and 20% next year. And the competitive intensity would be limited, right? So that business now is not at that 30-40% growth rate, which we saw post-COVID. The second is obviously a quick commerce where the growth can be very fast. And this is where what the market got interested was that the competitive intensity is now reducing. So that the discounting which was going on, I think with they will, players like Zepto and Swiggy also will find it, it's not sustainable to keep burning cash at discount. So what they guided for was that if they can get to EBITDA margin of 5-6% of net order value, you can have a 40% ROCE. And I think that is where the stock got a positive look because, at 40% ROE, if you can get to 5-6% margin, then it can build a scalable model. Secondly, if you see, they are also talking now from moving from a third party to a first party, which means they're, from a marketplace to having your own inventory. Now that will also add positively to the margin once the stores they are opening starts getting matured and normalized. Obviously, it will increase working capital. So I'm of the opinion, see, new age businesses, there is a bit of leap of faith you have to do because everything you can't put on paper and evaluate basis EV, EBITDA or price to sales, right? Obviously, they will optically look always expensive. And some part of the portfolio, so in this space, what you do is you pick 3-4 ideas where you believe the habits are getting formed and future. That is how people would have got hold of an Amazon or Nvidia, some time back. So you have to make some portfolio there. I'm on the side where you make a digital portfolio, take 2-3 bets, not very large ones, right? Maybe 2-3% each on some of the 3-4 names you are interested in. One could be Eternal, one could be Policy Bazaar, one could be, something in logistics. And then, be very prepared that either you're going to gain big or lose also significantly, right? This is how this space will work. If you keep comparing it with FMCG names and other businesses on digital metrics, you're not going to get it right. And I agree with people who have a counter view also that optically businesses look expensive, and if you don't get it right, you will lose significantly here. So you have to be prepared, as I said, win big as well as lose big.
Just to follow up on that, if you remember the last quarter's con call wherein the company very clearly stated that they are prioritizing growth over profitability at present, and that is the kind of impact we've seen on the Q1 numbers as well. How sustainable is this approach going ahead, given that yes, competition is rising, but like you mentioned, cash burn also is a big overhang right now?
In this business, typically in quick commerce and e-commerce, we have seen the winner takes all. So you have to defend your market share because only then you would make back-ended profit, right? And I think going by the pricing we saw last quarter, I think even the rivals are now being more prudent and not, as I said, burning money left, right, center, which also happened with food delivery, at some stage. Remember how many players we had? We had Uber Eats, we had Food Panda, we had so many names, right? Ola, etc. And now you largely have two large players, and then obviously there are few entrants trying to pivot. So my sense is once you get a leadership position, it's very difficult to dislodge. And right now, Eternal has roughly about 19,000 crore cash, which is much higher than the others, which probably need to raise more. So my sense is the competitive intensity will keep dying, and I think the NOV will keep improving because every quarter you are seeing improvement. There is a higher proportion of electronics and high value products and not just groceries. So as NOV picks up, and as the new generation is more keen and habits get developed, you're willing to pay some premium.
Let's move on with the entire quick food delivery and quick commerce space. But now let's focus from Zomato to Swiggy. Now, Swiggy is also all set to report its Q1 earnings next week. Let me take it across to my colleague Mansi for what Motilal Oswal is expecting this time around from Swiggy's Q1 and what are going to be some key monitorables to watch out for. Mansi.
So after a positive set of Eternal, now all the eyes are on the earnings of Swiggy. And if we have a look at the expectations in particular for Swiggy, while the gross order value for food delivery and quick commerce might see an uptick around 17% and 114% respectively, both for food delivery as well as the quick commerce. And at the same time, food delivery and quick commerce might take rates at 22.3% and 15.2% respectively. Whereas no major loss reduction in Instamart is expected yet, and Instamart might grow 28% on a quarter-on-quarter basis and margins at 16%. Out-of-home consumption is anticipated to be near break-even with 54% on a year-on-year basis, particularly for the revenue growth. There are a few other factors which one needs to consider is the Instamart gross order value and at the same time the average order value growth. These are the parameters, and we'll have a look at these numbers while the numbers and the earnings come out. And at the same time, the dark store additions, margins and the path to profitability. Another thing which one needs to keep an eye is the net revenue, which might see an uptick of around 11.2%. However, the EBITDA loss is might see an increasing trend of around from 962 crore to 1062 crore. So these are the expectations one needs to understand for Swiggy while it comes up with the earnings.
Right, Mansi, thanks so much for taking us through that. Gurmeet, give us your sense on what we can expect from Swiggy this time around, given that last quarter they pushed their profitability outlook for some more quarters. So that is looking rather lackluster, but they have reaffirmed to their food delivery guidance. So what's your take on Swiggy this time? Okay, we'll reconnect with Gurmeet in a bit from now, but let's also revisit once again what we are largely expecting from Swiggy this time around and what the brokerage take as of now quite recently has been on Swiggy. If you take a look at that, we have some mixed reactions coming in on Swiggy, and you have ICICI Securities that's maintained a buy, but they've also given the highest target price that we've seen across the board right now of 740 rupees per share. Ambit Capital continues to be bearish. They've maintained their sell rating with a target price hike of merely 8 rupees coming in from 292 earlier to 300 now. HSBC maintains hold. JP Morgan continues to be overweight with a target price cut of 540 to 500 now. So that's a little point of concern. But it's actually Kotak Securities that's supposed to be watched out for, because they've downgraded the stock to an add rating from a buy. This at a time where ICICI Securities has given a target price of 740 rupees. You have another Indian brokerage, that's Kotak, that is amongst the lowest target prices at 420, and Macquarie, ever the lowest prices always given by Macquarie, usually underperform stance coming in from Macquarie on Swiggy, and the lowest target price they've given for now is for 260 rupees. The stock at 417 thereabouts. It's going to be very interesting to watch out for what happens in terms of Swiggy. This big contrast coming in terms of the eternal brokerages that we've seen post Q1. If you take a look at the stock move for Swiggy also recently, the last 1 month itself, we've seen a 7.5% uptick coming in on the stock. 3 months also you have a 20.5% uptick coming in on the stock. What's slightly concerning is the 1-year move that we've seen for Swiggy right now. About 8.2% lower is what the stock has given in terms of 1-year performance. So of course, when the numbers do come out next week, all eyes are going to be first and most importantly on their commentary to path to profitability. This is going to be the most important metric to watch out for, and it's also going to be compared with Zomato, which is or Eternal, pardon me, that is very classic, because remember, Eternal also IPO'd when it was in loss, and it took a few quarters to turn to black. Swiggy seems to be taking slightly longer than that. So at least that is the outlook when it comes to Swiggy. And we have Gurmeet back with us. Gurmeet, so like I was asking you, your take on what we can expect from Swiggy's numbers, especially now that they have in the previous quarter pushed their profitability outlook.
So we'll wait for numbers to come in. We don't have Swiggy in the portfolio. We do have Eternal in the portfolio. But, one set of market belief, there is valuation comfort for the discount it trades at. So I think the key here would again be Swiggy Instamart in terms of how the unit metrics improve. And I think the market would be more keen on that. Food delivery, I think, also has seen some cannibalization in the last 2 quarters, even in delivery partners. So that also led to some softness, which I think now has been addressed, I think, in most entities now. So I think that's something I would look forward to before, developing any view on it.
So that's the take on Swiggy. Well, let's move on to the last company we wish to highlight on this show, and that is Ola Electric. Not surprising, lots of bull versus bear cases coming in on Ola Electric as well. Given the kind of block deals that we've seen on Ola Electric recently, this stock has been in focus, has seen its fair shares of swings and misses, ups and lows on the stock price. It's been a weak Q1, but the guidance was a beat provided by the company. It's among the top 3 EV players as of June, and they're going to be focusing on tech and advanced products. On the flip side, what we don't like is that losses have widened to 428 crores. They are losing market share on a year-on-year basis as well, and the stock is below its IPO price and roughly 70% off highs. Gurmeet, any quick thoughts on Ola Electric, and where do you believe this company is headed given the kind of price erosion that we've seen on the stock already?
No, I'm not sure on this. We've avoided this since IPO. My firm belief is that the traditional two-wheeler companies with the likes of TVS and Bajaj, etc., have a distinct edge over the new age companies purely on the sheer distribution reach, and the strength they have across, different, so if you see TVS, for example, it's present in the CNG space, in electric space, in the traditional, two-wheeler bike segment. Their EV variant, which is iQube now, is already the industry leader, continues to gain market share. So they have regular cash flows to keep funding the EV and other hybrid, programs they run, which is not the case for a new age company. And once you complete a 3-year, 4-year cycle, that's where the replacement cost and other things surface. In motorcycles and bikes, it is after 2-3 years once you complete your first warranty cycle. So somehow I'm not too bullish on the new age ones. I believe the traditional companies with the kind of product portfolio they have, distribution reach they have, strong balance sheets they have a clear definitive edge.
Okay, so Gurmeet liking the traditional two-wheeler plays compared to the new age ones. Gurmeet, really appreciate you joining us on the show. On that note, we'll let you go. But with that, viewers, we'll wrap it up on this edition of ET Now Insight. The focus is truly going to be on who can make it and who can last and lead India's new age digital journey. But with that, it's a wrap on this edition of ET Now Insight. Thanks so much for watching.